Anyone see why it's
It was like April. Nameless ones.
¿Qué? ¿Y cómo ven más?
Sit next to you, just like a German chef.
Like a what?
German chef.
Come on, they won the World Cup. You know who didn't win the World Cup? United Kingdom. Oh yeah, they did almost as well as we did.
And every other country in the world apart from
The U.S. almost drew them 2-1. So that's Brazil.
Yeah.
All right, everybody that's turning the quiz, get theirs back.
Well,
Here's kind of how you did as a class. You want to benchmark yourself. Overall, not bad.
So what's this mean? It means they beat the average.
12 people.
Yeah, those are percentiles. You got 10% of the people above 46 points. 25% above. That's nice. 25% above 44 points. Half of the class was above 39, the other half below 39. And then, 75 above 31, 25 below 31, 90% above 25. That's what that means.
So a little bit on the marching orders for today. Obviously, Dr. Geltner's gone, so we're trying to fill in some shoes and keep us on track. So show us a little grace with that. And we're going to dive into the IBET case a little bit. But first, we want to go over, we're just going to basically put up our grading sheet that we use for the quizzes with all the answers and how the points are allocated. So you guys can kind of go through that on the quiz, see what you got wrong. We can speak to some questions, but largely if you have questions on grading or certain questions on a test, let's circle up after class. We have office hours as well Thursday. So that's the wrong quiz.
Are we going till 7 tonight, or are we going to?
Yeah, when we're playing, I'm going.
We'll have a break in between, and then recitation is going to mainly be just underwriting. Common mistake on the cap rate for number one was taking 14.29 as the NOI, dividing that by the $300 per square foot. Most of you did pretty good on number three, both parts. Either. Either. What the answers we're looking for this, obviously, the 2,500 per person location premium, and the radius of 8.3. We did a lot of partial credit on this because a lot of you had the right formula, didn't add it right, or vice versa.
Oh my God. Right answer without any
Yeah. 60 months was a slam dunk for most of you. Number 6 was a little trickier. Common error was dividing that natural vacancy rate by 15%. So a lot of you came up with the 5, but you didn't divide it by 15%. The first part of that equation.
So for the problem 6, so I should deduct
For what number are you on here?
deduct on the existing structure from the
I'm sleeping with your sister.
Let's we'll catch up with you. We'll catch up after class.
Where did you bury the body?
All right, interesting. A lot of you guys on number 7 included either added or subtracted the 1.5% growth to the cap rate. The cap rate's like it's a still shot picture. You don't include growth with cap rate. So obviously it's a 6% cap. Some of you are looking at it as a 4.5 or some is 7.5. So don't include growth.
Can you explain part D, even though I figured out what you're getting at, but it doesn't make sense to me why the cost is different there than what was actually paid for it.
Yeah, so that was a question not many of you guys got right. I think 2 or 3 of you only got that right. Basically, the question, what the professor was trying to get at, it's that if you see the answer on 7C, the HBU of the site changes and the optionality value of that site increases. And that's basically why people are bidding more for that land. So basically now with the new HBU, actually you see it, he got it there. The bid price reflects the new HBU. So if you go over, you got the cap rate of 6%.
Sorry, I just used the scroll pad. Oops, sorry.
So they pay 50 million times the cap rate. They expect $3 million per year NOI. And then if you cap that to the cost, if you cap that NOI with the cap and cost to get the development cost, you would get actually, 3 million divided by 7%, it's 42 million. That would be the new development cost for the highest and best use. I don't know who asked the question,
That was me
but
next. Sorry, I just didn't. My confusion was where it says that it was actually sold for 50 million, and if there was any rationale as to why that would be versus the 42.
the higher. Well, the 42 is just what the market is saying that the developer, the cost of construction for that new HBU is.
Could be. Okay.
Could be. Yeah.
Are you asking why it sold for higher than?
Dave, Matt, or Dave
Why it
first.
sold?
The 50 million is what the new person would be paying for the land.
What he paid. Yeah.
What he paid for the land. So if he's gonna have some new highest and best use, it's gonna be an expense. There's gonna be an expense for construction or whatever they end up doing to the site to redevelop it, I assume. Or am I misinterpreting it? Because basically I felt like something was missing. Like this was the land price. And then, so the development cost of 42.86, that doesn't it just didn't make any sense to me. It seemed like there was information missing. And maybe I just misinterpret the question. But it seemed to me like the highest and best use total development cost plus land should be greater than 50 since the land cost.
Well, that's exactly. The 50 million is actually the property value, right? Not the land only. It's land plus the structure value.
But you're gonna demolish it for a better, higher, and best use. Normally,
Yeah, you can.
normally in the formulas we've been working with, that's a small percentage of the total development cost. But in this problem, you have a $42 million highest and best use, but you just bought the land alone for 50 million. I think that's
It's not It's not $42 million in highest and best use.
That's
Isn't
the
that what
cost.
part D
That's
is?
construction
Including
cost.
demolition, if that's what you're gonna do.
So then if you spent 50 million to buy the property,
The total development cost.
then the total development cost is the
exclusive of
cost
land.
of
It's
the
42.
development.
How much
Six.
would
Price.
that
That's
development
part
cost
D.
be?
Exclusive of land.
It's just taking, it's,
Man.
I still don't quite understand
Land
that.
plus construction.
Structurally, like,
42.86.
like, so
That
the
you
person
just
buys
bought
this
the-
property for $50 million,
And you
And they're
just
gonna
bought
invest
it for
some money
$50 million.
redeveloping it or whatever to create a greater highest and best use. So they'd have to spend more than $50 million, so they just paid $50 million for land. So how could the total cost, you know, your NOI is gonna be $3 million. Your value of the property has to be greater than what your for the property, or otherwise, I guess I don't understand it.
So, I
It
mean,
just seems overly simple.
yeah.
It made me question.
It is that it is simple, but, I mean, I quite did not get what you're asking, but, so the $50 million is the price that a new owner would pay for the property.
Okay.
That's structure plus land. Then if you cap that with the cap rates that you see in the market, that would reflect NOI, a yearly NOI that you expect as an investor to get out of that property. And then if you divide that NOI by the cap rate on cost, which is basically you know, a discount or a yield, not including the profit of the developer or the buyer, then you would get as what would be your replacement cost of the.
You just got me a point, man.
Which is 40% without profit.
Given this, you're supposed to given
Shouldn't the growth in the net cash flow at 1.5% have some effect on this? Because it's going to grow for perpetuity.
Yeah, when you're doing the cap rate analysis, growth is not a factor. It's instantaneous now, like a picture that you're taking. When you're doing DCF, growth is placed into the market. Many of you guys, give me just a second. So you got return equals yield plus growth. Remember, cap rate is this. Many of you guys use this formula, using this, I mean, this as a cap rate. If you have 7 or 6 or minus 1.5. But this is the total return, which is yield plus growth, ER. And we're talking about cap rate, which is without growth.
I guess I just don't understand. So the developer just paid $50 million for the property, so how does this cost 42? He paid $50 million.
Because you're paying the profit of the seller.
They're talking about the new buyer, not the.
Yes, but you gotta pay the profit of the other seller, of the seller.
I don't.
Yeah, I don't get it.
So if the replacement cost is 42.6 and this guy paid, he just got hosed.
Without, I said replacement cost, without profit. That would be what you would need. I mean, if you divide that by the 7%, you need a $3 million income minimum in the market, so you can start development.
Wouldn't you need a $3 million income just to be able to justify buying the property? You know what I mean? Like, if you're gonna, if you're buying something and you're capping it at 6, that
You
means
need
you're
a $3 million,
$3
you're
million.
gonna buy it at $50 million.
So that's it, but it doesn't make $3 million, it makes 2. So where does that extra million come from?
The optionality, it's gonna, the HBU change, or it's gonna change.
For the sake of time, I'm gonna
I
answer a few questions.
Yeah, I don't want to buy it.
We'll come back. We have a lot to cover today, but I want to get this in front of you guys. Then 8's the last question, more qualitative in nature, obviously.
I'm just wondering, were we supposed to explain A and B or just list them, like for the future?
You can do either,
Okay.
just as long as it had those things. So we, a lot of you use construction instead of structure and sort of those components. So. And then extra credit. You guys are all pretty much spot on this. And my boy Mike over here for that layup.
That was a layup. They doubled
In HC, we were looking for you guys telling us that in the first in the components of rent you have irreversibility, which is due to uncertainty, while on the components of value, most of them you have growth, which is not present in the component of rent, because you can have growth without uncertainty as well. Pretty much that was. If you said something about call option, expected growth, or growth without uncertainty, you probably have full marks or partial marks.
Like we said, any questions, just grab us after class, office hours tomorrow. The hash out number 7 will know with you as well. Sorry.
Are you putting out this on satellite?
No, I don't think so.
Why not?
Because
I mean, we would like to look at it more carefully than we did here, right?
We'll take that one.
I'll ask the professor. All right, so we've got a few slides. We're gonna, if you guys would take your tests, just put those to the side. We'll collect them. When you guys head out, if you don't mind, just drop them back up here after class. We'll take them back. So IBET is a case of obviously pension fund, and the thing that's interesting about this case is it involves something that's going to touch all of you at some point in your career, and that is, do we sell, do we hold, essentially do we buy, how do we value real estate, and at that, how does it become part of a portfolio? So to start this off, we've got some facts that Dr. Geltner put together just on the pension fund world. In a lot of pension fund that's been something that's happened since about the late 60s. It started to come into real estate. And before that, it really wasn't much of a thing. Do you guys know why pension funds now invest in real estate? Why it's a substantial portion of their portfolio? Some ideas.
Diversity. Securitization of real estate through REIT legislation in the 60s.
Helps? Yes, sir, Josh.
It's uncorrelated with the stock market, mostly.
Yeah, so the correlation component. Any other thoughts?
long-term hold periods, their commitments to over
Yes,
generations.
exactly. So you match the duration of your assets to the duration of your liabilities. Before this, there's a lot of mismatch. And something that's kind of interesting that's happening in the pension fund world right now is a lot of our parents and grandparents had the defined benefit plan, right? Where they retire and the company pays them a pension. Nowadays, most of you are probably more familiar with the 401k and the IRA accounts, which are on the rise. In defined contribution. So remember those two words. This is a little snapshot of the amount of capital that's out there from defined contribution and benefit plans, and then the allocation of assets. So as you can see, the UK has a lot of these pension plans. US is on their heels. Another one, some of the pension funds are in the real estate market to the tune of about $600 billion. Is anything in particular stick out to this on this graph to you guys as far as the assets or the allocation up here? be it public, reach private. You guys draw any conclusions between that and where, why endowments are heavily invested in one asset class or the other? Sir.
Something to do with 90% of the income from REITs is to be distributed, therefore endowments are foundations have a regular yearly cycle where they have to distribute income.
Right. Yeah, they like the coupon component because a lot of that money, especially from the endowment side, goes to fund the actual happenings in the school.
Endowments and pensions have a bigger allocation to opportunity funds because they want to beat inflation on a consistent basis, and they're not constrained by timing as much, so they want to take more risk, and so they go higher expecting risk.
Right, that's another one. So you balance, you can use real estate to balance out other aspects of your portfolio, and there's a range which we'll dive into in a bit between core all the way up to opportunistic opportunities in the real estate space, which is exhibited here. So do any of you have experience in real estate, private equity? I remember a little bit, so maybe you guys can help us out, lean on you a little bit. IBET invested in direct investment accounts with a manager called Galactic, right? So Galactic represented this separate account to invest directly in real estate assets. Who knows, can you guys that have been in the private equity realm, the difference between a commingled, these are all different types of private equity or investment funds that investment managers use. Joint venture, who can tell me what a joint venture is?
Usually you team up with a developer or a minority partner who's more of the operating partner, and if you're a pension fund, you have capital. So you're the majority financial partner, so and you will do a joint venture.
Awesome. Yes. So that's a joint venture is usually where you have a capital partner and an operating partner that join together to do a deal. That would be direct. You also have commingled funds. Who wants to get, Josh, give me a snapshot on those.
Yeah, so commingled close would be a fund that has multiple different investors, but it's a closed time frame. So you actually, you start the fund at one point and you close at a specific date, whereas an open is a revolving process.
Exactly. What type of fund is IBET invested in? Right. Yes, it's direct, obviously, but is it open or closed ended? Closed? Yeah, it's a closed ended fund, which a closed ended fund, how Josh said it basically has a life frame. So these guys can invest their money on the front end and know that it's a 5 to 7 year window they'll get their money back. And usually those investment managers will say, hey, we're gonna give you a set return, be it 15, 16%, and a multiple of your money. So it's an IR and a multiple component. What's one of the challenges between having an open fund versus a closed fund? Because if you guys are reading on some of this right now, you'll see that the open funds are kind of on the rise, especially after the downturn. Anyone want to take a shot at that?
There's no liquidity there's more liquidity requirements as an open fund because you are taking redemptions and you're allowing fresh money to come in every time. And after a while, it also becomes a problem to manage money because the fund size actually goes quite big. And you might, the tendency is you might do some investments which you might not do if you're a closed fund.
Right. So what Fonnie's saying is basically on an open-ended fund, how they have, you can come in and go out at certain time periods. So if you invested, if you were IBET, you put $25 million in an open-ended fund, you would have investment periods where you could invest your money, and then you would have other periods that would have no closed off window, because once a closed-ended commingled fund is closed, so your money's locked and it's in there until the end of that fund. So think about that. This is just to frame your mindset around IBET. What Ms. Carissa is in the process of doing is figuring out where their allocations are. And being a direct investment, they have the ability to decide whether to enter or exit different assets along the way. They didn't invest in the fund.
Just to add one more point, the point why open-ended funds might be more in demand right now is due to the fact that people invested before the peak. They put most of their money in closed-ended funds, and they had to be extended because your investment results were not great. So, I mean, an open-ended fund gives you that flexibility. That and obviously there's also a gate there sometimes when there are a lot of investors trying to redeem at the same time. But you still get a chance to redeem at some point. Maybe if you put in a request today, maybe 1 year down the line, versus a closed fund, which it's the investment management institution generally.
Yeah, funny brings up a good point. The problem with closed-ended fund is what if the 7 years in the fund term was up in 2009, and you had $100 million of your money in real estate holdings? That'd be terrible. You usually have into the documents, the fund documents, you'll have extensions built in of usually 2 1-year options that they can elect to take. But at the end of the day, that could be very problematic, which is why these open-ended funds are becoming more popular. And then this is your basic risk return model right here. And you kind of see how these assets fall in line. Your core, that's going to be your major MSAs downtown. Core plus might be like a building downtown Boston that's at 86% occupancy instead of 95. So there's a little bit of a bump value add you can take, especially if you think leasing velocity is good and you're going to be able to get higher rents. Value added and opportunistic are out there because they use a little bit more leverage. And we've got a basic.
Hang on, what does SML stand for?
Security market line.
Thanks. Yeah, what does that mean?
The line of efficient return if you combine it with the risk-free asset.
Exactly. So your risk-free asset is right here. What in real estate do you generally use as a risk-free asset?
T-bills.
Sorry?
T-bill.
T-bill, right. So your treasury rate. So that's going to be what you can put your money in. You can park it in cash and basically bank on that at zero risk on the U.S. government. And so these move up and out the risk return curve a little bit. As you can see, core and core plus it's kind of like buying a bond in a sense. A little bit more risky depending on the asset. And then the value add and opportunistic gets out there a little bit further. And opportunistic usually involves development, mezzanine debt plays, those type of things are a little bit more niche. Here's a brief synopsis on each. And a common way to think through it is basically, two cash flows between appreciation and the cash flow of the asset, right? Where are you getting most of your income from? So in your guys' opinion, where would Greenway Point fall in on this? Where would you guys put it? Who thinks core plus? Put your hand up. 1, 2, 3, 4, 5, 6. Value add? Couple. How about opportunistic? That good. Core. Who thinks it's a core play? A lot of no votes in here. Jeez. All right. So this is going to be an interesting investment committee when we jump ahead here. Here's a look at performance on different funds. Yes, sir. Carlton.
In the previous slide, there was a sentence: leverage is used. Previous one.
Sorry.
In the value add, leverage is used to enhance returns. So does that mean that you'd be basically taking out a mortgage to develop the property?
I'm sorry?
Would that mean that you would be taking out a mortgage or a loan to develop the property?
Essentially, yes. So you're juicing returns here by juicing leverage. And that's what pushes it out on the security market line and incurs more risk, but you also get a lot more return on your equity. And so because of that, a lot of these funds and investment managers basically promote these funds. They're saying, hey, we're going to run an opportunistic fund. And our returns are going to be higher than the guy that's running the core plus or the value add. I actually wanted to show you this real quick. This is kind of cool. This is a list of funds from March. And you can kind of see how they frame themselves, right? Like, you have all heard of Franklin Templeton, probably. Their real estate fund, and they're a fund of funds, which means they pull money from large organizations and then invest it in other funds. G4 Capital investing in high yield debt, Garrison and Gall are out on the opportunity side, and then how much equity they have to play with. So there's a lot of research done on these guys. It's pages and pages. But just to kind of give you an idea, because IBET may sit down and say, hey, we want to allocate, of our 10%, we're going to allocate to real estate. We want to put 3% in the opportunistic bucket, and let's put 7% in the core plus. A little bit safer, lower return, but overall, it's going to be where we want it to be. So just to show you guys a little something out of the real world.
I have a question. What do you mean by juicing? I'm still like top on.
Oh, sorry. It's basically by applying leverage, you're increasing your returns. All right, so you're increasing rent and you're increasing your returns. Okay. If
implied that, but I wasn't quite sure.
Yeah, you're fine. So this is a little bit how these funds performed in the downturn. Core, obviously a little bit safer, lower returns, not as much of a peak, but then not as much of a trough. Whereas your value add, so this is kind of how it plays out in reality. And this is why it's important to think about it as an economy as a whole, just the cyclicality of real estate. So this was your homework. Hoping most of you had a chance to at least value the asset and read through it. I want to talk through this slightly. There it is, in glowing color. This is Green Lake Point. Gorgeous. We're going to take a poll. If you had a chance to look at this, I do this for Dr. Geltner. By show of hands, how many would you say hold this asset? There can be no votes in this. You need to pick.
What if we have
Hold
no
percent.
idea how to evaluate that? Yeah.
Then we'll get to it later. But right now, off the cuff, I want you to think, would I hold this asset or would I sell it based on what you know right now? So we have
Are we being graded on this side?
All right, how many of you want to sell this? Put your hands up. You have to vote. 4, 5, 6, 7. All right, 7 say sell. I need 4 volunteers who came up with the valuation on this asset to give me their number. And then we're going to compare it to classes past and work through it. Josh.
16.6.
16.6.
Really? Hey, high five, guys.
All right, next. I need another value.
10.7.
I'm sorry?
10.7.
10.7.
Conservative underwriting.
10.5, 15.5, 13.5. Yes, sir.
12.7?
12.7. All right, so as you guys can see from this, I mean, based on just how you guys have looked at this, you have 4 different interpretations of value and 4 different, obviously, people are going to buy. So if you're selling it, I would be looking for Josh, and we'd be working the deal right now. Yeah. I think what we want to get to later. So some 34 of you say hold on this, 7 say sell. Anybody say it was worth less than $5 million? 5 to 10. Nice. 10 to 12. 1. Put your hands up. Don't be ashamed. There's no right or wrong answer for this.
Well, actually,
Then why are we required to vote?
It's the marketplace. 12 to 13.
When are you gonna get started?
It's funny.
Oh, wait, I got on this DCF stuff.
13 to 15. Over 15. All right. Here's how last classes, this is how 2012 said. They did evaluation.
Okay.
Huh.
2011.
12 million. So we got it right.
Oh, right.
2010. A little bit more pessimistic.
How do you get there, to be honest? Very good.
And here's the layout that you were given in your case. Basically, so CFO is cash flow from operations, same as your NOI. This is more of an accounting term. What did you guys do with the debt? How did debt factor into your valuation? Not to use it. So why would you not use debt in your valuation? Yes, sir.
We are calculating the enterprise value.
Okay, calculating the enterprise value. Unpack that for us.
So we are calculating the enterprise value and the in order to arrive at the equity value, we use the equity. We will use the debt to
Exactly. So when you factor out, when you're evaluating assets, you do not take into account the debt. Because what you do as a private equity firm or as an investment firm, as in her shoes, you are basically looking at a snapshot of the asset in this current place in time and determining a value for it. And so debt for Javier is going to be different than debt for Josh, right? And that's going to be different than AJ, because you guys are all going to have different credit scores, different balance sheets, and banks are going to lend to you differently. Some people are going to get loans at a higher interest rate, lower interest rate, more loan to value, less leverage. So keep that in mind. Never use debt when you're valuing an asset. So it stops right here. To your NOI line. Okay, when you're looking at this from a personal perspective to invest in or not, you're going to want to break it down and look at everything below the line as well. So this is called above the line, and this is below the line. You'll hear that reference. Below the line is your tenant improvements, your leasing commissions, your debt, your capital expenditures, right? Like if you had to put a new roof on, that's going to fall below the line. You're not going to count that in your operating expenses, because the next guy that buys this is not going to figure in an extra $500,000 for his operating expenses. So this summer, I had an internship here in town with a private equity shop that had $1.2 billion in assets under management. And twice a year, they have to value the entire portfolio, every asset for each fund. So we spent a whole lot of time doing this. And it is incredibly important because there's several reasons why this is vital. For one, if you're looking to raise money for your next fund, all of the potential investors and how your business model has worked out thus far. So that gets really challenging. This is a lot easier than if you had a development project that was halfway finished. How are you going to value a development project today that's halfway completed? So that's when discount rates and a lot come in. But for assets like this, we usually use a cap rate, which is how you guys did this. And you basically you figure out a cap rate from the market, and then put in basically what somebody else would be willing to pay for it, and put that over the NOI. And what's interesting about these is that it doesn't matter when you're valuing this. the value is not contingent upon when you bought it, right? Or how much you paid for it. It does not matter when you're looking at it like this. For Ms. Carissa's sense in IBET, it matters as to whether she holds it or sells it in a portfolio, because she's going to incur certain costs in insuring the assets. But when it comes to just the sheer value of the asset, it doesn't matter. And then usually you take those values and your cap rates, your discount rates, and that's what's audited by your accounting firm, right? So a PwC is going to come and sit down and look at your fund and determine whether you use the correct cap rates and valuation methods for this, and they'll put a stamp on your value. So you need to be able to defend it. So that's the point of this whole case, is to get you guys to think through, how do we value assets? Why is this important? What's its role in a portfolio? Because you will use this someday, assuming you own the real estate realm. So here's the basic sense. Yes, sir.
Yeah, I'm just curious. Do rents not get taxed? Why isn't there a tax line in your cash flow from operations?
Great question. So that would fall below. So there's a property tax that's charged by the local municipality.
But what about income tax?
No, that falls below the line, because your income. Yeah. He's talking about the income tax. Yeah, property taxes and insurance are above the line. Your tax rate is going to be different than my tax rate. And I might be a corporation, I might not be an individual. So that would come when we look at it from our own circumstances, whether we buy an asset or not. But for the sake of valuation, it's considered below the line. Does that make sense? Does that answer your question?
I think my question was more on corporate tax rate. So corporations, you have your EBIT, and then you pay off the tax, then you get your cash flows, and then
Correct.
you add back all the non-cash items. So I'm just wondering, when you buy a building, say if you're a corporation and you buy a building and the building generates rents, do you not get taxed as a corporation on your profits every year?
Yes, it depends on how the corporation is set up, obviously, but yes, you do.
And shouldn't that factor into the cash flows as well?
It would affect your cash flows, obviously, after taxes. But for this,
so we are assuming no taxes.
For when you value assets, that's kind of like some of the lines between finance and real estate, or the financial realm, is that you do not consider taxes when you're valuing assets because of differences. So if you were looking at this and I was looking at this, this is a number that we can both agree on. Yes, sir.
It's kind of like the EBIT, right? It's interest before, or earnings before interest and taxes. So the taxes haven't came yet. Instead.
Okay.
Yeah.
Cool.
So here's how you guys came up with your answers. It gave you a spread in the case, 9.5 to 10.5 on the cap rate range. We'll dive into that here more in a minute. But you guys all remember this from module 1. This is NACREIF data, just showing basic cap rates for apartments, industrial, office, and retail assets since '91. It shows you where Green Lake kind of falls in there. The cap rates for this actually stands a little bit lower, around 8.75. And this kind of states the obvious. It's tough to nail down. Is it a 9.6 or 9.65% cap rate? And that can have a substantial effect on your pricing. Yes, sir.
Do you know if there's a floor on a property size that can make it into the NACREIF index? Because, I mean, if the floor is $20 million properties, then it wouldn't be relevant.
Those are all going to be more core. Exactly. The NACREIF, is it 4 to 5 to 10? I don't exactly know there, but you're right about that. And so 15% can be substantial. And some of the implications for investors, they talk about like fuzzy valuations. Fuzzy valuations is kind of a funky term, like juicing, for assumptions, right? So what are your assumptions? So are we assuming a 3% rent growth over time or a 1% rent growth? How's inflation and depreciation coming into that? So just something to get you guys thinking about this. And when you did your valuation, what were some of the assumptions that you took into effect?
Rent growth, discount rate, terminal cap rate.
I'm sorry, funny, I can't.
Rent growth, discount rate, terminal cap rate.
Terminal cap rate, discount rate. How would some of these valuations be affected by your assumptions? What assumptions would you use? When we're talking about just growth rate, inflation, depreciation, that sort of thing. So that's what we want you to be thinking about here. Before we jump into this, I want to just rehash some of the IBET case. And when you're looking at a deal, especially in this scenario where you have Ms. Karras who's trying to decide to keep or sell different assets, how would you approach that? What would your thought process be? Who can give us a brief synopsis on timing and where she stands with the whole IBET? She just got promoted. Where does she go from here? What does she do? Anybody? Josh.
So once she has her valuation, just talking about this one particular asset, I would look at what we bought it for and kind of do a postmortem and see if we sold it for that price, what kind of return would it give us? And
Okay, but even before that, what's in the first page it talks. Here's what we're looking to do. What kind of lens does she have on when she's thinking about this? Because this is important. You need to remember what your company is wanting you to do with this. There's a lot of different goals, different reasons people would have to invest in real estate. I think it's the first, second paragraph in there, maybe.
You talking
about whether you want to be a direct investor or not, or
more on why would you bring real estate into your portfolio?
Diversification.
Anybody else?
Diversification and
okay, yeah, diversification. You want to diversify away from strictly being in public securities and other assets. What else?
inflation hedge.
Inflation hedge, right? We have one more that kind of ties into the previous slide on volatility.
Lower the volatility of the portfolio.
Exactly. So those three things is how she's thinking about whether we hold or whether we sell these assets. Once she has that down, obviously you took Greenway Point, you're sort of sifting through Greenway Point. Josh, continue on from there. You said.
Yeah, so once we have our valuation, then we kind of look back and say, if we can sell at that price, what kind of return would it give us? As you know, with our going in price and everything. And then if it meets our hurdle return or not, that'll tell us what to do with the asset.
Okay, nice. What do you guys think of the market? What market is this in? Where's it located?
Between
DC. Okay, yeah, kind of DC suburbs. Who's from DC that can paint us some color for the suburbs?
It's closer to Baltimore, actually.
Okay, Baltimore, exactly.
It's a pretty far out suburb of Columbia. Columbia, Maryland's a pretty far out suburb.
Okay.
Definitely. Yeah. I mean, you might have some professional service firms out there, pharmaceutical type companies. It's a bunch of one-story, like Class B office buildings, basically.
Does this fit the mold for what's out there?
Yeah.
A lot of product.
Yeah.
Generally pretty good quality tenants, from what you can tell.
It's a long slog on the beltway to get out there.
Long beltway. What's the transportation like?
Have to drive.
Have to drive.
Definitely.
Okay.
Surface parking, no structured parking, lots of land.
So barriers to entry, maybe not incredibly high.
Yeah, very low. I would
Based on land.
imagine. Yeah.
What other things did the case give you guys as far as information on the competition?
2 new buildings coming up.
2 new buildings coming up. What are the rents on those buildings? $15 gross net.
Triple net.
Net. So what on our building? How's that compared to where we're at right now?
Much higher.
Higher. Okay. What are the rents on our building?
1306.
1306, about $20 gross. So what's the difference between a gross and a net lease? If you guys are looking at this market, this deal's on your desk, and you're saying, I don't know whether to keep it in the portfolio or not. We have new product coming on that's getting $15 net. We're charging between $13 and $20 gross. What's the difference? Is that good? Is that bad? Are we positioned well? 13 is very low. Why is it low?
And real estate.
Which are Okay, so did you guys catch that? A gross lease includes operating expenses, or excuse me, does not include operating expenses. So you need to deduct your operating expenses out of your gross leases to arrive at a net lease. So if your competition's coming in at $15 a square foot, and your rents are at $13.06, the case, I believe it says it's $4.69 in operating expenses, and everything over that, it's basically a $4.69 cap, which means the tenant takes on any extra expense that comes over that. Yes, sir. Matt.
I'm curious if there's a way to quantify the newness, which is their obvious advantage of coming online and being brand new versus our older property. Is there a way to quantify that in the model?
You would not in the model, no.
Okay.
Yeah, it'd be more qualitative and then based on assumptions.
Yeah.
And you want to look at the market with that one.
Okay.
So if we have leases in this building at $13.06 less $4.69, we're roughly in the $8.50 a square foot range net. And so competition is coming out almost double what we're charging right now. And we also have some in there that are at $20 gross, less $4.69, so we're right on that $15 net, right?
Are you subtracting the 469 from the gross? Because that's the tenant paying the gross amount of 13, and we're
Correct.
paying the 469. They pay whatever's above the 469.
Yes.
Yes, exactly.
So we actually don't know what to subtract from the 13.
Correct. My bad on that one. Exactly. So we have rents. How's our occupancy looking? What's the occupancy in the market?
It'd be better.
It's 95.
95%, give or take. That's strong, looking good.
Yeah.
What's the occupancy in our building?
92.
92. So we have room to improve it a little bit, which would kind of, in my head, lead me towards that value add space if we were looking to sell this potentially. So we have rents in the market higher than rents in our building. What's our lease duration like for our tenants?
5 to 10.
5 to 10.
Yeah.
So 5 to 10 years out before our leases start to turn. We have a little bit of space we can lease up. The things are looking pretty good on that front. How about overall market absorption? Did you guys pick up on that? What's vacant? What's been leased? Who can tell me what market absorption is?
What the market is currently leasing at. The vacant space market is currently backfilling with new tenants.
47,000.
It looks like here
What's
it's
that number?
47,000 square feet for the last quarter. And the largest 12 transactions in the last period included 60,000 square foot tenant, 8,560.
Perfect. So looking at this and how it can fit into our portfolio, what kind of cap rates did you guys use to value it and why? We can go back to the prices you guys threw out, but how about this top row here? What kind of cap rates did you guys come up with? Anybody? Yeah. Okay, we used 10 to split it. Okay. Anybody use something other than 10?
I used a 9 cap. I think the range they gave us was 8.5 to 9.5 for suburban office. So I just said.
R&D.
Isn't this an R&D building?
Yes, it is.
Yeah.
So I think you're 9.5 to 10.5.
Oh. Don't call me again.
Gotcha. Yeah. So that is largely how this scenario works. Is you look at it macro to macro environment. How does it look in comparison to what the assets we're looking at acquiring or holding in this case? So just bear that in mind as you guys come through the rest of these in the next couple of weeks. So we're gonna go from there. Yes, sir.
So quick question. What about discount rate? I mean, that's a big factor in the thing, and I didn't have any guidance on that. Or unless I missed it. Oh, did it? They don't call me.
I think it's Exhibit 2.
Is it? Okay.
Yeah, check that out. So basically what we're gonna be looking at here going forward, the rest of these assets do not have debt attached to them, it's all equity. And we're gonna be working with DCFs, and so that's the discounted cash flow, where you project out basically the performance of the property and factor in escalators to rent, inflation, and the like. So we're going to help you guys work through some of the Excel components of this. And basically go over the homework to make sure you guys are all on the same page.
So
I think everyone has an idea about like what DCF is in general, right? So up till now we were just using the normal formula, doing the NOI, we had the cap rate to come to a value, right? Now imagine like you do not have, how would you actually come up with an NOI if no one actually gave you that this building is earning this amount of money at this point in time, right? So if you want to like holistically think about, I'm going to hold this asset for say 10 years and I want to like sell it after 10 years. So how would you in a educated way make a guess of what your projections are going to be and how much rental income you're going to actually get? So in DCF, what you do is you actually go to the building, figure out how many leases you have, you figure out what is the actual rent you're earning, you put everything down, then you kind of make like different assumptions. How long are these tenants going to be there with me in the building? What kind of expenses I'm going to be making in the building? And you try to be as realistic as possible to come and arrive at a value for the projection of the building, right? So this is generally it's 10 years long term. You see the total return, and the bubble thing is so cap rate is very fuzzy, right? If you use like a 6% cap rate versus a 7% cap rate, there's like a huge difference in the amount that will come up. So this just helps you to really be realistic that 5 years down the line, you're not caught up like thinking, oh, the market is really growing. You have like ups and downs in your rents. You make sure that your DCF flows in a coordinated manner all throughout. So I'm actually be going to the Excel. Like, do you guys want to pull up all your Excels out for the IBET case? That would be the best way, I think. So to go line by line, see how they've actually valued the whole building and what are the different components of it, and we can all figure it out there. And so there is obviously no right or wrong answer to a DCF, right? It's your perspective. How do you look at it? Like I can value a building completely different than you value a building, and a third person can value it completely different. So it's all based on your assumptions. What is your sense of the market? What is your sense of the building? And how much information do you have about the building? So it all depends upon what level of information you have. And so Zach actually touched on this one, risk-free rate and the risk premium. So risk-free rate is obviously the government bond USD bills. So that's why in the SML line that even at 0% risk, you have some return coming in. So that is the safest of the safest option. And the risk premium is obviously how much risk do you want to allocate to a particular asset. So suppose the risk-free rate right now is 3%. And so risk premium is your variable, right? Risk-free is going to be like fixed. And then you're going to decide how much return do you want. If your building is really in a safe location, very well maintained building, you want a very small risk premium on it, right? Because you're saying that the building is very safe and you don't see that many risks in it. And vice versa, you keep adding the risk premium as the building becomes more complex. So here, this is Dr. Geltner's very famous word, we go garbage in, garbage out. That is exactly how in DCF works. You can put in like all sort of nonsense assumptions and you'll get like really wrong answers. And so basically just trying to say that the typical mistakes people make in DCF are they always overestimate the rent growth. He also spoke about the depreciation, if you guys remember. Everyone uses the 3% number, but in general, no one takes into account like 1.5% that we actually miss out on depreciation. But still people keep adding 3%. That is one common mistake. Second is people always underestimate the capital expenditures and the operating expenses while actually doing a DCF. And third thing is the managers like a lot of times think, I'm smarter than the other guy on the market and I'll be able to manage this building way more efficiently than the other guy. So those are the few typical mistakes that people make on DCFs. Capital improvement and
the discount rate. Okay, another point that I wanted to touch on this one is what do people do at times? Lot of investment managers do this even presently, is they'll actually make the DCF and they'll use the higher growth rates, right? And they'll project like NOI is really increasing a lot and we have X amount of money and it's growing by 5% every year. And while presenting it, they might use a higher discount rate. So they'll be like telling the investors, oh, we put the higher this one, but we are using the higher discount rate. So our investment is even super safe. So imagine if you compress the cap rate even a little bit more, we'll have a lot of money. But in theory, that works like, like someone could buy it. But the main problem with, thinking about it in those terms is, suppose you're always in this misconception that your NOI is too high, then you're only betting on your discount rates. You're betting that, oh my God, even if this is like not true, even if I'm getting a 200 basis points lower than what the investment managers think, I'm still going to make money. So it's always better to be as realistic as possible with your projections on NOI. So this is exactly what I was saying. So NACREIF NOI, see the black line keeps growing every year. It just goes one trajectory, but the actual inflation is not catching up with it. So we are growing it at a higher rate than the inflation.
And it's the other way around. CPI is higher and the NOI doesn't catch up.
Okay. So in general, the mistake is that we will use higher.
Basically, it goes back to the same point. If you overestimate your NOI, it doesn't work. Over and above inflation.
Why are you doing here?
That's right. Yeah, and NOI growth over time has not kept up with inflation. And this is further shown. There's an interesting paper out there. It's called 100 Years of Real Estate. Look at Manhattan. It's basically Manhattan pricing over 100 years of assets. It shows, for those of you in Wheaton's economics course, we could probably post a copy of that paper, but it's an interesting read if this is interesting to you. So it kind of deflates the idea that of real estate is an effective inflation hedge. It's not perfect. It helps, but it's not perfect. Yes.
Hey, Zach?
Yeah.
So if NOI growth can, over a very long period of time, be relied upon to outgrow inflation by maybe a modest amount, is that a pretty good case for making your projected, at least your projected gross income grow faster than your OPEX in a pro forma? Because Geltner had it set it to 3% and 3% in both cases. And it's a pretty common industry standard, at least from where I sat, to set it at like 3 and 2 and just watch that split grow as you go. I mean,
does it really grow like that?
Maybe not 3 and 2, but you could use that as a justification for it if you're ever going to buy it. Like if the performer doesn't add up, We're just looking for some ammunition here.
Yeah, allowed to correct.
3 and 3.
All right.
Question back here.
Wouldn't you be passing along like whatever the expenses, the way they increase if they increase with inflation, wouldn't you be passing it along to the parents, and wouldn't that sort of would want to keep your NOI in tandem with?
Yeah, so you're saying if in a lease, if you had a tenant that leased space from you and their rent increases each year were tied to the CPI index, is that what you're saying?
Yeah.
Yes. So that would, if you had leases and the rent growth each year was tied to this index, then it would obviously track the index fairly well. That's why people like hotels and apartments as more of an inflation hedge, because, or if you had a lease that wasn't tied to CPI, right? If it wasn't tied to the inflation index. The nice about hotels is you mark to market every day. You have 24-hour leases. Apartments, it's usually 12 months. So annually you can mark to market. The problem would come in is if you had a 10-year lease, like you might have with Greenway Point here. And you did, instead of tying it to CPI, you just tied it to a 3% increase, in 5 years or every other year, and inflation spiked and went way up. Then you would have a situation where your NOI was not keeping up with inflation.
Can go the other way around as well. Like even if the inflation might spike up or spike down. So you have to be like as realistic as you can to keep up with the inflation. So underwriting haircuts. So basically this is the whole bottom line is I think so how realistic you can be on DCF and you can at times people do it deliberately. That's what David is trying to say. You might just project it like why would you do it deliberately if you're pitching to someone to buy and you want to make sure you want to get a deal done. You might deliberately change the growth rate. You might to show lower costs and you can come up to whatever answer you have like in your mind by doing the numbers. But the important point is to understand and read the numbers and find out like how realistic you are with the market assumptions as of today. I think let's just go directly to the Excel investment mistakes. Unrealistic expectations, investment mistakes, allocation decisions, and financing decisions. So same thing, right? Long run undermining credibility of the DCF. If you're not going to do it the right way, obviously you're undermining the credibility of the whole analysis in the first place. Wasted time, and then lastly, failure to protect against bubbly or overvalued prices. Okay. Why don't I just hook up the Excel and then all the components we can go over in the Excel itself, one after the other.
Until we get 10 minutes, it's just, we'll knock out these slides and you do that presentation.
So cash flows, like two types of cash flows, operating and reversion. So what is the operating is actually what the rent you're gonna get plus the other income. What is the other income? So in every building there'll be like in common area maintenance, right? The tenants are gonna pay you maintenance, they're gonna pay you the rent. So those are the two major things you might get back from them. Thirdly, you might get like insurance, property taxes. If you're the one gonna pay the taxes, your tenants will reimburse you for taxes. So that is one part of which is all the operating incomes. And then what is the reversion income is actually when you sell the property at the end of the 10 years when you want to sell your property, that is your reversion income. Like you actually making money by selling it to another party. Okay, I think so. Zach went over, right? So the first you get all the NOI, you remove the operating expenses, etc. Once you come to the final NOI, right? That is your net operating income. After that, so property before taxes and cash flow. So PBTCF. So what is PBTCF is net cash flow produced by property before subtracting debts and taxes. So in real estate, we put all the debts, we put capex, leasing commissions, TIs, everything goes below the line. So above the line, there are only major three portions would be A, your revenue, the total income that you're generating. You'll remove the vacancy, and thirdly, you remove the operating expenses. So once you're done doing these three major steps, you pretty much arrive at your NOI, and rest, all of it will go below the line. So NOI minus capex, you'll come to the PBTCF. And property value at time of sale. So selling expenses right now in the market are around like 2%. People generally assume it goes anywhere between 2 to 6%. So depends upon what kind of property, what location, what local. So those are the selling expenses. The selling expenses you would only remove it from your reversion cash flow. When you actually sell it, that's the time you'll deduct the selling expenses. So how to forecast vacancy? Okay, do you guys know how it works when you actually do a DCF? How do you incorporate vacancy in the DCF? So see, this is a probabilistic method when you do a DCF. Okay, so if suppose in your documents, okay, there'll be an OM given by any broker to you. It will say like the DCF assumes 70% renewal probability. Or so what does that actually mean is that there is 70% chance or probability that your existing tenant is going to extend the lease, and there's 30% of the chance that he won't do it, right? So you have to factor in that loss of like 30% also in your DCF. And another way you have to like be very, very specific, like which portion of your building is going to be vacant for how many months, so depending on the market again. So you will have all these assumptions given with you from a broker, like the market says 6 months is the time it takes for a typical new tenant to come in. So it might be 6 months, 9 months, 3 months. You need to just figure out with terms, like if you have a good hold over the market over several months, you know that what is a typical time does it take for a new tenant to actually see the space and come into the space. So that's how basically you will figure out your vacancy rates. I'll go into more depth about how those 6 months or 9 months are incorporated in the revenue and how the 30% versus 70% is incorporated in your DCFs. But just understand the general concept that you need to figure all this out. And what should be the typical relationship? So usually, see, going in and going out cap rate. Going in cap rate is what you buy at. What cap rate are you buying at? Going out, like what cap rate are you selling at, right? So you want to make money, right? So obviously, usually your going out should be greater than or equal to your going in. And so an interesting concept, so there are 2 types, right? There are 2 types, just keep in mind. So when people generally invest, there's one, people want to make money out of just operations, right? And second, people want to make money out of cap rate compressions. Okay. This is just, I'm giving like some general stuff. So. And always remember this is a very simple rule. Okay? 7-10 rule. I'll tell you what. If you're making 10% returns every year, okay? You're making 10% returns every year, you're gonna double your money in 7 years. Okay. In general, whoever your investor is would ask for a 2x multiple. That is what the market, what is going on right now. So generally speaking, suppose if you're relying on your operational income, most probably, you would want like it's getting like 9 to 10% of your IRRs for 10 years so that you double your money in 7 years. Secondly, cap rate. So, or at times what happens is your NOIs are pretty flat. Okay? They don't go, you're not adding any substantial capex or anything else for which your NOI is really going up or down. NOI is supposed to be pretty flat, but you think that locationally this suburb is gonna like boom in like the next 5 years. This suburb is gonna change completely. They're gonna be like new infrastructure, new roads coming up, and today I'm buying at a 9 cap. I'm gonna sell it at like a 6 cap. Okay? So that is one way of looking at it, is cap rate compression. And at times you want to look at like a strategy of both maybe. So these are the 2 basic, operational income and cap rate. So going in, going out has to be greater than or equal to. So if you're equal to, then you're making money out of operations. If you're more, you're obviously trying to compress the cap rate as well. And apart from this, okay, so value, again the basic fund structures and everything on, so value add and everything. So there are no like real clear-cut definitions about what percentage to what percentage is value add or what percentage to what percentage is core. All of this is still again very fuzzy, where you lie, which portion, like what is your investment strategy, how you want to go and like look at the building. So, and value add, like leverage is one component, as Zach said, and the second component I would say would be what value are you bringing to the table? Are you really changing the lobby? Are you changing the elevators? Are you changing some real infrastructure in the building? Are you adding some value to the building so that you will have a higher NOI or a higher sale price? So think of it as holistically in terms of how do you want to invest. Yeah. I think this is Any questions? I know there are a lot of questions. We're gonna go forget about the Excel completely. We're gonna go over that in regular recitation. Any conceptual questions about like DCF, vacancy, like any other questions?
That's it. Well, thanks. Appreciate you guys. And in closing out, just a few takeaways. Remember, you're valuing the rest of these assets. You're going to be looking at it from a discounted cash flow and also a cap rate. So think about which one of those would best value the assets you're going to use. And remember to just think about it from a pension fund perspective. Put yourself in her shoes when it comes to holding or selling these assets as a hedge against inflation, lowering the volatility and the diversification component. And then also think through how much capital she's going to need to put out over the next couple of years to meet their new 10% or 5% real estate. Take your tests and set them up here for us on the way out. And we will have recitation today. Contain your excitement. And we're going to be looking at basically underwriting and building out these DCF models in Excel. So feel free to send out for that. Thank you.
Thank you.